Welcome to Iron Financial. This is the channel where we help you forge a stronger portfolio by cutting right through all the market weakness. Today, we are putting on our hard hats because we are stress testing the very foundation of a market titan, Berkshire Hathaway. Now, the first earnings report of the post-Buffett era is officially out, and you better believe the headlines are sending some serious tremors through the market. So really, there's only one question that matters today. Is the fortress that Warren Buffett built still structurally sound, or are we finally seeing the first cracks in its foundation? Let's dive in. So this is the headline from the Grand Pinnacle Tribune that's got everybody talking. It's a real gut punch for investors. Steep profit drop. I mean, come on, those are three words you never ever want to see attached to the giant from Omaha. And you have to understand, this isn't just another earnings report. This is the very first real-world test of the new leadership, of the entire Berkshire model, really. The market is watching, and you can be sure, so are we. A steep drop? You know, that's putting it pretty mildly. Is this it? Is this the moment we've all been sort of quietly wondering about in the back of our minds? For 60 years, Buffett was the bedrock. He steps down, and the very first report under the new regime has a headline like this. You just have to ask, is this the first major crack in the empire? That, my friend, is the billion-dollar question. And today, we are absolutely going to answer it. So here's our plan of attack. First, we are going to dissect this earnings report piece by piece to separate the headline noise from the financial reality. Second, we're going to analyze the new CEO Greg Abel's first shareholder letter. That's his blueprint for the fortress. And finally, we are going to comb through their 13F filing to track where the capital, the actual money, is moving. By the end of this, we will have a verdict: fortress or facade. Okay, let's just go ahead and confront that ugly headline number head on. The reports are practically screaming about a 25% drop in net income for the full year 2025. You know, that's a fall from nearly $89 billion all the way down to just under $67 billion. Now, on the surface, that looks absolutely catastrophic. It looks like a sign that the engine is seizing up. But with Berkshire, you always have to look under the hood. And this right here, this slide shows you the two very different sides of the story. On the left, you've got that scary headline number, that brutal 25% drop in net earnings. But you have to remember, that figure includes all the paper gains and losses on their absolutely massive stock portfolio, which, swings wildly with the market's mood every single day. Now, on the right, you have what Berkshire themselves call operating earnings. And that, folks, is the real cash profit generated by their actual businesses. We're talking the railroads, the insurance companies, the manufacturers. Now, that number was down too, yeah, but by a much less alarming 6.2%. Well, hold on a second. Operating earnings. Is this just some corporate jargon, a fancy accounting trick to hide a really terrible number? Every company has some kind of preferred metric they trot out when the main one looks bad. Are you sure this isn't just hype to soften the blow? I mean, I see a 25% drop, and you're telling me to just ignore it and look at this other number that just so happens to be conveniently smaller? It's a fair question, but this isn't some new trick they just invented. For decades, Warren Buffett, and now Greg Abel in his very first letter, which is telling, have urged, practically begged investors to focus on operating earnings. So why? Well, because it measures the actual real-world health of the hundreds of businesses they own, everything from See's Candies to the BNSF Railway. The net earnings figure just gets tossed around by the daily chaos of the stock market, and that's something they can't control. Operating earnings, on the other hand, measure the real performance of the engine room, and that is exactly what we're here to inspect. Okay, fine. I'll concede the logic there. It does make sense to separate how the companies they own are doing from the whims of Wall Street, but hey, let's not pretend the number on the right is good news. A 6.2% drop in your core businesses is not a rounding error. That's a nearly $3 billion decline in profit from the companies that are supposed to be the bedrock of this whole fortress. It's still a pretty significant crack, if you ask me. I agree, 100%. A crack is a crack, and our job is to inspect it. So let's do that. Let's drill down into those operating businesses. We need to find out exactly which pillar in this giant structure is showing signs of stress. This slide really gives you a sense of the sheer scale we're dealing with here. I mean, even with that drop we talked about, Berkshire's businesses generated over $44 billion in operating profit last year. And you can see the load-bearing walls of the structure right here. The insurance operations, that's combining both underwriting and investment income, they're the biggest piece at over 44%. And right behind it is that massive collection of manufacturing, service, and retail businesses. These two segments right here, they're the twin engines of this whole conglomerate. And it looks to me like one of those engines is sputtering badly. I'm looking at the details for Q4. And that insurance segment you're highlighting as a strength? It got hammered. Insurance underwriting profits didn't just dip, they plunged 54% in the fourth quarter. That's not some small leak we're talking about. That's a gaping hole in their most important business. You're not wrong. Q4 was absolutely brutal for insurance underwriting. But let's look at the full year numbers to put that quarter in context. For the entire year, underwriting profit, as you can see in that top line there, was down 19.5%. A serious blow, no question about it. But now look down the table at the other pillars. BNSF Railroad, the literal backbone of American commerce, saw its profits climb almost 9%, from $5 billion to nearly $5.5 billion. Berkshire Hathaway Energy was up over 6%. And that huge manufacturing and retail segment, it grew earnings by over 4%. See, this is the core design of the fortress, diversification. When one wall takes a big hit from something like catastrophic storms, the others are there to bear the load. Absorbing, maybe, but it's definitely showing the strain. The report itself talks about sluggish consumer demand. That's hitting their classic, all-American brands like Duracell and Fruit of the Loom. And we can't just ignore the investment side of the house either. They took a massive $4.5 billion write-down on their Occidental petroleum stake and another $3.76 billion hit on Kraft Heinz. The report literally says these losses are not temporary. That sounds an awful lot like a permanent crack to me. Which brings us to the man in charge of all the repairs. We've inspected the damage, now let's go ahead and inspect the foreman, Greg Abel. I mean, for years, he was the heir apparent, but now he is in the hot seat. The numbers are weak, the pressure is absolutely immense. Is he really ready to fill Warren Buffett's shoes? What's his plan to patch up these cracks and reinforce the whole structure? So, Abel addresses that question head on in his very first shareholder letter. And his opening salvo, it isn't about numbers or strategy, it's about culture. He immediately invokes the late, great Charlie Munger. This quote is his foundational promise. He's telling shareholders loud and clear that the architectural blueprint isn't changing. The values, the principles, the very DNA of Berkshire. He sees his primary job as protecting all of that. He's positioning himself not as some revolutionary, but as a preserver of the faith. And this quote right here, this gets to the very heart of his message. He's making a direct pledge to every single shareholder. He's saying, look, this isn't my company to reshape in my own image. I am the caretaker, the steward of the capital that you have entrusted to us. Now, this is a really powerful statement about continuity and responsibility. He's basically framing his entire tenure as an act of service to the legacy that was built long before he took the job. Words are cheap. Stewardship, culture, legacy, I mean, it all sounds great in an annual letter, but talk doesn't pay the bills. I want to see the steel and concrete behind that pledge. What tangible assets, what hard numbers are there to back up this promise of stewardship and actually prove that the fortress is secure? Well, here's Exhibit A, over $373 billion in cash and short-term U.S. Treasuries. This is the fortress-like balance sheet, and that's a term Abel uses himself. And this isn't just some rainy day fund. This is a hurricane-proof, earthquake-proof financial bunker. It is an absolutely unprecedented war chest that gives Berkshire the ability to withstand almost any economic storm, and maybe more importantly, to strike with overwhelming force when opportunities finally pop up. And here it is. This is the real treasure buried inside the fortress, the insurance float. It's the money that their insurance companies like GEICO collect from all of us in premiums before they actually have to pay out any claims. Think about it. You pay your car insurance premium today, but you might not have an accident for years or maybe ever. That cash doesn't just sit in a vault. Berkshire gets to hold it, invest it, and earn profits on it. It is essentially a massive interest-free loan from the rest of the world. And right now, that loan stands at $176 billion. This is the secret weapon that fuels the whole machine. Which brings us to the great contradiction here. You're showing me a war chest of over $500 billion when you combine the cash and the float. Yet, the report states this was the 13th straight quarter where they sold more stocks than they bought. And, get this, the 6th straight quarter with no share repurchases. They're sitting on a mountain of dry powder and they are refusing to fire a single shot. How is that good stewardship? It looks like paralysis to me. And that's because you're viewing it as paralysis. But Abel's letter frames it as extreme discipline. This is his playbook, and the key principle is right there in the middle. Disciplined capital allocation. He writes, and I quote, "We will remain patient and disciplined in pursuing the right ones." So this inaction, it's a feature, not a bug. They believe valuations are way too high across the board, so they're refusing to swing at bad pitches, just like Ted Williams. They're waiting. And while they wait, they aren't totally idle. They made smaller, targeted acquisitions like OxyChem and Bell Laboratories. These are classic Berkshire businesses with durable advantages. It's a sign that they're still hunting, just not for elephants. So if they aren't out there making these huge acquisitions, what exactly are they doing? Well, let's move on to the 13F filing. This is where we get to see how their disciplined, patient approach is actually reflected in their publicly traded stock portfolio. This is where we can track the real-time strategic shifts they're making. Okay, the portfolio is still incredibly concentrated in just a few key holdings. The top 5 names you see right here, they make up over 70% of the entire public portfolio. Apple is still the undisputed king at over 22%, but the others, Amex, Bank of America, Coke, and Chevron, are all absolutely massive positions. This is a snapshot of their core, long-term convictions in American enterprise. But even these pillars are being chipped away at. The filing shows they trimmed that Apple position by over 4%. They cut their Bank of America stake by nearly 9%. They're selling their biggest and best holdings. That doesn't exactly scream long-term conviction to me. It looks like they're quietly taking profits and heading for the exits, even on their own crown jewels. And you know what? The trimming in Apple is absolutely nothing compared to this. This was the headline move from the 13F. They unloaded over 77% of their Amazon stake in a single quarter. This is a massive strategic retreat. After holding it for nearly 7 years, they have effectively dismantled the entire position. The signal here is crystal clear. They believe the valuations and big tech have gotten far too rich, and they are taking profits and de-risking in a major way. Okay, so they're fleeing tech, they're trimming the banks, and they're sitting on a mountain of cash they refuse to deploy on any big acquisitions. So where on earth are they rotating this capital? What do they see as a safe harbor in this market? What's the lesson here for the average investor? This slide right here shows the strategy in action. It's a clear, defensive pivot into quality and into tangible assets. First, a new position in the New York Times. That's a classic moat investment, a powerful brand with recurring subscription revenue that's incredibly hard to replicate. Second, they added over $1 billion to their Chevron stake, increasing their bet that tangible, hard assets in energy are going to outperform in an inflationary environment. And third, they boosted their position in the insurer Chubb, doubling down on the very sector where they have their deepest expertise. The crucial point here, the lesson for everyone, is they are rotating out of high valuation growth and into quality businesses with pricing power, hard assets, and sticky recurring revenue. Now that is a playbook for a market you think is about to get rocky. Okay, we have inspected the earnings, we've analyzed the CEO's blueprint, and we've tracked the capital flows. It is time to bring all the evidence together and render a verdict. Is this a solid fortress built to last, or is it a crumbling facade? And here it is, the final balance sheet. On the left, you've got the cracks, and they are undeniable. Operating profits are down, the core insurance business is facing serious headwinds, iconic consumer brands are sluggish, they've booked billions in permanent write-downs, and yes, the stock has been lagging the S&P 500. But on the right, the fortress walls are just incredibly thick, nearly $400 billion in cash, another $176 billion in float, the core railroad and manufacturing businesses are still growing and highly profitable, and you have a new, disciplined CEO with a clear, conservative framework. My verdict is this. The cracks are real and they are undeniable. The era of easy compounding growth that really defined the Buffett years, it's over. This report proves it. The insurance tailwinds have turned into headwinds, consumer strength is fading. The pressure is now squarely on Greg Abel to prove that he can allocate that mountain of capital more effectively than the market itself. And so far, he's chosen not to. This isn't the end for Berkshire, not by a long shot, but it is the beginning of the heavy lifting. And my counter verdict is that the fortress is structurally sound. The headline noise about a 25% profit drop completely misses the immense underlying financial strength and the $44 billion in actual operating profit. The so-called cracks are just cyclical business challenges that this diversified model was explicitly designed to withstand. The portfolio changes and that massive cash pile, they are not signs of fear or paralysis. They are signs of extreme discipline in what they clearly see as a frothy, uncertain market. Abel is doing exactly what Buffett would be doing, protecting the foundation and patiently waiting for the perfect pitch. So we're going to leave you with the ultimate question. The fortress walls are thick, we know that, fortified by hundreds of billions in capital. But the cracks in its operating performance are just as real. So you have to decide for yourself, is this a structure built to endure for another 60 years? Or is the really heavy lifting for Berkshire Hathaway just beginning? So is your portfolio built on a solid foundation? We'll be back next time to help you find out. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.